Hello, everyone. Grayson Geiler here with Secure Estate Solutions. Every week, I like to get some news from the financial media and go a little bit further into depth. And this week, we're going to be talking about the bank failures. Okay, so we've had a pretty wild couple of weeks in the financial markets, considering the second and third largest bank failures in U.S. history behind Lehman Brothers. The Silicon Valley Bank and Signature Bank, they are in receivership at the Federal Reserve. So it's very trying time, especially considering the billions of dollars that were deposited, especially in Silicon Valley Bank. That's the high profile one. You've got Roku supposedly had nearly $500 million in their liquid assets sitting at the bank. It looks like so a lot of people are really banging the drum that this is some crazy behavior on the part of the bank. Clearly, these banks were not well run, but were not part of the party that would call them criminals or even reckless. We think the Federal Reserve created this environment, and some of the more volatile and maybe not so well run banks are the first to fall. The good news is Federal Reserve has a lot of stops that they're shoring up to try to support the financial markets, to try to support the banks in general. We're going to talk a little bit about those. And so we are not predicting doomsday by any stretch of the imagination. So what is the Federal Reserve doing? What are the national banks doing? The first thing, it looks like the Federal Reserve is going to make good on all the deposits at these banks. Now, that hasn't been explicitly stated yet, so it's kind of implied right now, but we're talking about a lot of money and a lot of concern for large companies that maybe have millions of dollars that they do in monthly or biweekly payroll. Well, they might leave those assets sitting at a Silicon Valley Bank, and then it gets swept into their payroll process. So it's a huge concern. Looks like the Fed's gonna make good on that, past the normal $250,000 FDIC insurance that more than likely we're all familiar with. Another thing they're doing is opening up. So right now they have the Fed has the discount window to provide something on the order of 90 days of liquidity for companies, small, mid, even large size companies. The interbank lending is going on. The one thing that the Fed has just done is now, because let me rewind for a second. When all these assets poured into Silicon Valley Bank, the Federal Reserve, after COVID, just conjured trillions of dollars out of thin air. So many assets came pouring into Silicon Valley Bank because it was in the volatile new tech innovation side of the economy. Everybody wanted to be a part of any new innovations that were happening. So money poured in. Well, now that the credit situation is tightening up, money has gone back out the other side. Well, what does the bank own? When the money came in, interest rates were basically zero. Silicon Valley Bank has to play by the rules that the Fed has laid out for it. So they were buying many assets, including treasuries that were very high priced, very low yielding. And now that the Fed has taken interest rates up so high, so quickly, a lot of these assets are underwater, 10, 15, 20% maybe. So when Silicon Valley Bank has depositors wanting their money back, they have to sell some of these assets to give them their money. Well, lo and behold, they're insolvent. So the Federal Reserve has stepped up and said, okay, Silicon Valley Bank, other banks as well, you can borrow against these assets rather than sell them. You can borrow 100% of the purchase price for up to a year. They've already said, we'll look at it in a year, which of course means that loan is going to go on further. So they are backstopping the situation, and especially when you hear the news, 200 other banks are teetering on the edge, on the brink of despair. Credit Suisse, that's something we talked about on our weekly a few months ago. Federal Reserve threw a line of credit out to Credit Suisse to help them. Now it looks like the Swiss National Bank is brokering a deal and subsidizing a deal for UBS to absorb Credit Suisse. Not sure that's going to fix the problem. whatever disease Credit Suisse may have, they may simply be infecting a larger host. But that's usually how these banking crises tend to happen. We are kicking the can further down the road. That's exactly what's going on. Another thing the network of central banks are doing to support markets worldwide is there's usually a credit line, a swap line that the central banks provide of dollars that'll happen weekly. They're reading by the old crisis playbook, and that's going out daily now to support financial markets around the globe. So the good news is it looks like the contagion has at least been stalled. Looks like the marketplace has anticipated that. By the marketplace, I mean stock and bond markets. There's not really much of a dip to buy because the panic's gone. So not super excited about pouring more assets into risk where we are now. I want to show you another part that the Fed is doing now to support markets that they have done in the past. So this is a look at the balance sheet of the Federal Reserve. So the Federal Reserve, our central bank, and I didn't see it anywhere in congressional mandates that gave them the authority to acquire $9 trillion in assets over the years, but that's what they did. So after the Lehman Brothers crisis, 08, 09, you can see the Federal Reserve's balance sheet less than $1 trillion doubles inside of a year. And as the years go on, the Fed continues to purchase assets. A lot of times in times of crisis when people need liquidity or maybe they have assets that aren't really worth what the Fed is paying for them. So the Fed has acquired quite the portfolio. Now you see, fast forwarding here to 2020, you see after the COVID crisis, a rocket launch in the size of the Fed's portfolio. So they were buying everything that wasn't nailed down. The Fed came out March, April, May, June, July. 2020, they even bought junk bonds from the marketplace. They were backstopping everything. And the process continued, like I've talked about repeatedly. The process continued not kind of too long, not mostly absolutely too long, and way too long. And the Fed, right at a year ago, finally got some religion and said, okay, we've got to reduce the size of our balance sheet and we have to raise interest rates. And they did that. We talked about it over the last few months quite a bit. It's actually been pleasantly surprising how well the marketplace, how well the economy is held together, while the Fed has raised interest rates at a blistering pace, faster than they have in 40 years, fighting off the inflation that they caused, largely through zero interest rates in the chart you're looking at right here, but some other behaviors as well. But the marketplace held together very well. Much higher interest rates. Not only is the Fed not buying assets predominantly in the bond market, but they're letting these assets mature and roll off the balance sheet. They're even selling some of these assets. So that's a dampening effect on the financial markets, and they took it very well. Well, in the last week, something finally broke, 2 weeks, call it, and the game has changed. So you can see just on this chart, Fed got up to almost $9 trillion worth of assets, 700 billion sold off, and in 1 week, $300 billion just got added on. So not only all the things that I've already discussed about providing liquidity for the marketplace, the Federal Reserve has actually gone out there and purchased at least $300 billion worth of assets. This comes out every Wednesday. We'll see more stacked on this Wednesday. So the game has changed, and not in a good way. Again, we're not predicting doom. Things held on way better than we ever anticipated over the last year, but a word of caution. Now, going forward, we'll see how much the Fed is going to have to buy. Now, the interesting thing about this is the Federal Reserve has another meeting this week where it's anticipated that they're going to be raising rates again. Well, they broke something with these higher interest rates. They're having to backstop it so it doesn't run into a contagion across the whole banking Complex, are they going to raise rates again? We'll see. The Fed funds rate, the last time I looked at it, was still predicting a 0.25% interest rate from the Fed this week. They're reading from a playbook that says higher interest rates equals lower inflation. We don't subscribe to that playbook, plain and simple. It's much more complex than that. And I'd be disappointed if the Federal Reserve raises rates this week, because really they're becoming arsonists and firemen. And it looks like they might start doing it simultaneously. Again, not predicting disaster, but not a dip to buy just because the contagion has been contained. So if you need to make some changes to your portfolio, one thing I would highly recommend to everybody is to own some gold. If you've got some and you want to own more, I would never try to talk you out of it. I would actually encourage it. Next week, I'm going to talk a little bit more about owning gold, how to hold it, maybe earn some interest on it on a low risk basis. And we'll go from there. But hey, thanks for spending some time with us. Smash the like button down there. Feel free to forward this to other people. And also feel free to reach out to us if you'd like to sit down for a no obligation consultation. We'll spend some time with you. Here's our information on the screen right now. Again, thanks for your time. Subscribe to us, and we'll see you next week. Thanks.